Good morning. It's Jeffrey Christian of CPM Group. It's about 10:35 here in New York on Tuesday, the 24th of September. I want to talk today about the issue, will lower interest rates lead to higher inflation? It's a topic that has come to the fore following the Fed reducing the Fed funds rate last week. Sure, the simple answer is probably not. There will be some effect. It probably will be very minor, but our expectation is that lower interest rates will not lead to higher inflation. Now, I'll talk about that in a second, but one of the first things is you have to understand and have a rational view of what we mean when we talk about the Fed having shifted now to lowering interest rates. There are people who keep talking about how interest rates are going to go back down to zero interest rate policies. And that probably will happen during some future financial crisis, but it's probably not going to happen in the next couple of years or in the next several years, right? What we're probably looking at is interest rates, which were peaking around 5.5% and are now down 50 basis points to around 5%. The expectation that the Fed has and the expectations that are reasonable, assuming that we are moving into a mature, or we're continuing to move through a mature stage of an economic expansion, possibly facing a small recession at some point over the next couple of years. A reasonable expectation that interest rates will come down further over the next 12 to 24 months and get down into, say, the 3.5, 3.25 range. So another 1.5 to 1 3/4 decline. So you are talking about lower interest rates, but you're not talking about the kind of zero interest rate policies that we've seen in the past. Second thing is that if you look at the root causes, what actually causes inflation, monetary policy, interest rates, and the provision of money supply probably is the third most important sector causing inflation. The primary cause of inflation are the supply and demands of goods and services in the real economy. And I'll get back to that in a second. The second factor are fiscal policies, including but not limited to deficit spending, the overall fiscal largesse. And monetary policies are really only the third most important factor. So when you say, do we expect higher inflation or increased inflationary pressures, you have to really look at the factors that cause inflation with an understanding that, with all due respect to the monetarists, they were wrong, and monetary policy is not the end-all and be-all, the only factor that fuels inflation. This is U.S. Treasuries, and you can see that they actually have been falling for some time prior to the Fed's reducing rates. That's partly because there was an expectation that the Fed would reduce rates, and it was also because of reduced demand for those treasuries from a variety of places. You can see it's still high. The demand is actually close to record levels for total treasuries on a global basis, despite what carnival barkers will tell you. Central banks are not dumping U.S. treasuries, nor are they dumping the U.S. dollar. The U.S. dollar holdings as a percentage of central bank foreign exchange is basically the same as it's been. It's at the bottom end of the range that we've seen over the last 40 years, 58 to 62%. No one's dumping dollars. No one's dumping treasuries. Treasury rates have risen. They've gone up almost to the lowest levels that we saw in the period from the 1960s. This chart only goes back into the 70s. From the 1960s into really to the year 2000. So interest rates are higher than they were when we were seeing a zero interest rate policy. from 2008, 2009 onward, but they are not so high as they were prior to 2000, 2008. So interest rates are coming down, and that is a factor. Will it fuel inflation? Probably not, because again, you have to look at inflation. And here is that spike in inflation that we saw in 2021, 2020. And you can see that those people who scoffed at the idea that high inflation, over 5% was a transitory phenomenon in a post-COVID, post-recession, post-lockdown situation, they're scoffing at thin air. It kind of looks transitory to me. But then transitory is in the eyes of the beholders. But you have to look at the causes, the root causes of inflation. And you also have to say, within the real economy, what are the portions or sectors of the economy that are more or less inflation or interest rate sensitive? The two most interest rate sensitive portions of the economy are the housing market and the auto market. Both of them are suffering from long-term structural problems, shifts in the supply of housing and automobiles, shifts in the demand for housing and automobiles. They have little to do with interest rates. So interest rates, higher mortgage rates have had a marginal factor in limiting housing sales. But other factors, the high costs, the unsuitability of the housing being bought relative to the housing that is being sought. You have housing construction companies building very large, expensive housing, and you have this tremendous need for and demand for smaller housing, starter homes and empty nester homes. The kind of construction we saw in the 1940s and 1950s and 1960s in that post-war economic boom. And they're not being built because the construction industry wants the margins that they get for the big houses and the luxury apartments. And so you have an imbalance in the supply and demand for housing. You have higher housing prices and a lower stock. You have demographic shifts, all of which have been much more problematic in the housing market than the mortgage rates. My first mortgage rate was 11% in 1981. So when people start to complain about a 5% mortgage rate, I just sort of say, kids these days. Similar imbalances are occurring in the auto market, which are problematic to auto sales and purchases, and much more problematic than the financing that has been available and will continue to be available. Now, if you disaggregate inflationary indices like the CPI or the PPI or the Personal Consumption Expenditure Price Index, what you see is that the inflationary pressures that remain in this period, 2021, 2022, when we had a spike in inflation from virtually 0 to 9%. And since that time, inflation has come down to around 3.2%, depending on which index you're looking at. If you look at where the inflationary pressures remain, that spike had to do with the post-COVID, post-lockdown period, tremendous amount of fiscal stimuli. I mentioned it in my last video. In 2020, we had a budget deficit of $3.7 trillion. And in 2021, it was $2.7 trillion. There was a lot of money that the government put out. Monetary policy had to follow that. I'll talk about that in a minute. Monetary policy, monetary authorities had to patch over the fiscal irresponsibilities of governments. A lot of that money came into the economy in 2021, 2022, and fueled that spike in inflation. That fueling of the spike of inflation due to that fiscal and monetary accommodation is behind us now. There are increased inflationary pressures that were not related to that, or that were triggered by that, or were allowed to emerge by that. And if you look at where the inflation is today, the inflation is primarily on the service sector, the provision of services, and it's transportation services, and it is medical services. Those are not particularly interest rate sensitive forms of inflation, sectors of the inflation. Those are the higher inflationary pressures we're seeing in transportation and medical services relate to changes in the workforce, and those changes have been emerging and are persisting. So when I look at CPI, I say, okay, what is the root cause of inflation? The first thing is supply and demand imbalances in the real economy for goods and services. A lot of the goods have come back in line now with that long-term lower inflationary pressure, but we have service pressures in the service sectors, some service sectors. That is not necessarily interest rate sensitive, so lower interest rates are not going to necessarily push up inflationary pressures there, nor will they particularly be leading to inflationary pressures reemerging and breaking that 30-year, 40-year period of lower inflation that we saw starting in 1983, 1984. Right? The second factor is fiscal policy, which is still overly stimulative. I think the deficit this year is about $1.4 trillion. It's half of what it was in 2020, 2021, but it's still very high. But it's half of what it was. Government spending, not only in the United States, not only at the federal level, but also at state and local levels, and on a global basis, government spending is being constrained by economic realities. It still has some inflationary pressures because it's still stimulative, but it is far less stimulative than it was 4 years ago. So some of the inflationary pressures are off. Then you get to the third factor, monetary policy. Will lower interest rates lead to higher inflation? There will be some upward pressure on inflation as interest rates decline, but it will be relatively minor, and it will not be anything that causes us to go back over 5% inflation. And by the way, anybody who plays with their inflation figures and comes up with these high inflation figures, they're not good economists. So our answer is lower interest rates will have very little effect in pushing inflation higher, and probably will keep the economy going at some point. Now, what does that mean for gold and silver? Talk about it in a second. I want to drive this one home. Insofar as the Fed and other monetary authorities have lost independence over the last several years, really the last decade or two, it has not been through legislation or regulations limiting the independence of monetary authorities, but rather that monetary authorities have had to fashion their policies to take account of the negative economic effects of large and persistent fiscal deficits and fiscal spending. And having to take care of that and stanch the bleeding, if you will, during recessionary periods, has preempted monetary authorities from undertaking monetary policies that they otherwise would pursue. So there are a couple of ways that you can lose your independence. One is that if you have to pay attention to putting out the fires that governments cause, that in essence, de facto, as opposed to de jure, reduces your ability to act independently. On top of that, you have authoritative and demagogic governments now, not only in the United States but elsewhere, that are wanting to reduce regulatorily and legislatively the authority of monetary policies, which would be a terrible mistake. Monetary authorities should have as much independence from government and from politicians as possible. What's all this mean for gold and silver? I showed you some charts last week about the relationship between interest rates and gold. I didn't show you charts about inflation and gold, but it's all the same. The reality is that you are in the late stages of a mature economic expansion. We may be headed toward a recession. If not, we're probably headed to a period of even slower economic growth. Inflation pressures will come off. Interest rates will decline. Real inflation-adjusted interest rates will probably remain close to 0 to 1%, 1.5%, which is not high enough to really cause investors to say, oh, I can lock in 1% real returns on treasuries. Why would I want to own gold? And then you have a political environment, which is much more important than those interest rates there. So we don't think that the decline in interest rates will have a particularly negative effect on gold. If anything, it might be somewhat positive. And we think that it probably takes the back seat to other economic factors, financial market stability, and political questions. And that's all I have for now. Here's one of the charts I showed you last week, which is a scatter plot, changes in real interest rates versus changes in gold prices. And you can see the correlation is negative 16%. There are extremely large periods of time when interest rates and gold prices both decline. And there are a lot of times when interest rates decline, but gold prices rise. So the correlation is not clear, not fit. And this is where you see it. When you look and say, where is it that higher interest rates cause investors to pivot away from gold? It's when real rates are more than 3%. If you have 3.2% inflation right now, and you have 5% Fed funds rate, that is, if I do my math right, about 1.8%. So you're still in that period where investors are not going to say interest rates are high enough relative to inflation that I don't need gold in my portfolio. Bottom line is our expectation is that gold prices, investors will continue to want to buy historically large amounts of gold, and that will keep gold prices high and strong. You can go to our website, you can buy our yearbooks, you can buy other research, you can find a lot of free readings and everything. If you want us to work with you, you can send us a note at info@cpmgroup.com, and we will start a dialogue that will lead us to figure out how best CPM Group can be of service in you in managing your exposure to precious metals and commodities. Talk to you on Friday. In the meantime, be good to yourself, be good to those around you. Try to do something good for the world.